I think we need to talk a little bit about what is going on in Washington, what is going on in Congress. So we're recording this on September 21st. It'll be published on September 30th. Now, the proposed reforms in Congress were summarized in a document released on September 13th by the staff of the House Joint Committee on Taxation. So that got reviewed the next day by the House Committee on Ways and Means. That was on September 14th, 1 week before we recorded this, and then was published to the world, basically what they're thinking about in Congress. There's a few things you need to know about this. The first is that they're planning on going through the reconciliation process. What does that mean? Essentially, what that means is that it's filibuster proof when it gets to the Senate. And with Democrats controlling the House and the Senate and the White House, chances are, in some form, this bill is going to get passed. Now, I normally don't spend a lot of time talking about bills that haven't yet been made into law, but I'm kind of making an exception on this one for a few reasons. One, it's fairly likely that something that is going to get passed here. Okay, so that's number one. Number two, almost everything in this bill is going to affect you. The worst part about this is that I'm probably going to have to update like 1,000 blog posts on the site because of all the changes that are going to happen. It's almost like the people writing this bill went through the White Coat Investor website, found every way that we can save money on taxes as high earners, and put the kibosh on it. Okay, so what's the big picture for this? Well, as I mentioned in a post that I published last week, I think it was on the 24th, last Friday. You can go and read that if you prefer getting this sort of information in written format. But the big picture there is that Congress is controlled by Democrats. Okay, the House, the Senate, and the White House, of course, too, are all controlled by Democrats. And a few years ago, you may recall that the opposite was in place. Republicans controlled the House, the Senate, and the White House. And what did we have? We had a big tax bill that cut taxes. And so it shouldn't be any surprise when Democrats control all three houses that we get a tax bill that increases taxes. And so that's the big picture. More so than that, President Biden has said many, many times that his priority is to not raise taxes on anybody making less than $400,000 a year. Now, that's a little bit nebulous, right? There's all kinds of income out there, total income and adjusted gross income and taxable income. And it sounds like there's even going to be another kind of defined income that comes out of this process. But basically, $400,000 if you're single, $450,000 if you're married. These taxes are all aimed at people making more than that. Now, they're still going to affect people that make less than that. And we'll talk about that here in a minute. But for the most part, that's who they're aiming at. They basically are feeling that high earners are not paying their fair share and should pay more in taxes. So that's the big picture that you need to understand as we go into this discussion. Secondly, remember that this thing is just a bill. Okay, like the old song that you hear when you go to your kid's presentation in elementary school, right? It's just a bill up on the hill. It's a long way to become a law from a bill. And so while it's good to be informed and try to make an impact on your elected representatives, in fact, I highly recommend, by the way, that you contact your elected representatives and express your probable displeasure with this bill. One of the easiest places to do that is at house.gov/representative/find-your-representative. And you can send them an email. I've already emailed my representative, although I'm already quite confident he won't be voting for this bill. But at any rate, I wouldn't make a lot of changes to your financial plans based on something that's just a bill. Okay, it's going to change significantly between now and when it becomes a law. It's good to know about it. But for the most part, be careful making changes. If it's not a change you would do if this thing doesn't become law, you really ought to think twice about whether you want to do it until it becomes law. Now, there's been a lot of talk about some changes that could happen that are not in this bill, and you should be aware of that. One of which is an elimination of the step up in basis at death. Now, this basically says when you die and your grandkids inherit your house, it's as though they bought your house on the day you died. That's the step up in basis on death. For tax purposes, they don't have a gain. Whatever gain you had in that or your taxable portfolio or the value of your business or whatever is all wiped out. And they start with the value on the day you died. So that's their basis for that asset. That's not changing. That's good. I think that would be bad policy to change that. And obviously, it's going to cost the next generation a lot of money in taxes. But I think that was a good move they made, and I'm glad the Democrats on the committee recognize that. Another thing they've been talking about is equalizing capital gains taxes and ordinary income tax rates. Now, they're talking about raising both of those, but they decided not to equalize those. Again, I think it's bad policy to equalize them. There's a couple of reasons why long-term capital gains taxes are lower than ordinary income taxes. One is recognizing that a lot of those gains are just inflation. You really shouldn't have to pay taxes on inflation. But two, it encourages investment. So I think there's a good reason to have a lower long-term capital gains income tax rate. So that's not changing either. So let's talk about what is changing if the bill is passed in its current form. Probably the biggest change is the ordinary income tax brackets are going up, primarily the top one. Now, this is totally misleading, though, right? Because they say, well, we're basically just going back to what it was before the Trump tax cuts 3 years ago. We're going back from 37% to 39.6%. That's kind of misleading, though, because right now, the top tax bracket, if you're married, doesn't start until $628,000. But under this bill, the top tax bracket will start at $450,000. So it's not just people going from 37% to 39.6%. There's going to be a lot of people going from 35% to 39.6%. So they're also changing where that bracket starts. The other thing they're doing is creating an entirely new bracket. Now, granted, this bracket is not going to affect most of the people listening to this podcast because this new bracket starts at $5 million. $5 million in their new taxable income. And obviously, most people, even very, very successful doctors, don't have $5 million in income a year. But nevertheless, it's a new tax bracket. And it's basically, they're not calling it that. They're calling it a 3% surtax, but it functions like a tax bracket. So in reality, the top tax bracket is going from 37% to 42.6%. And yes, in addition to that, you've still got the 0.9% Obamacare tax. You've still got 2.9% Medicare tax on top of that. And of course, you've got state taxes, which in my state's about 5%. In California, the top bracket is 13.3%. That all still applies. In fact, somebody making millions of dollars a year in California is going to be looking at a marginal income tax rate of about 60%. That's right. So 3/5 of every additional dollar they make is going to the government. Okay, so another big change, increased capital gains tax brackets. Okay, instead of the top tax bracket being 20%, it's now going to be 25%. And yes, guess where that's going to start? If you're single, 400,000. If you're married, 450,000. That one's not going to affect me as much. I don't pay a lot in capital gains taxes just because we tend to donate our appreciated shares to charity. And we have lots of tax losses saved up from the Corona Bear. And of course, just like you tack on that 3.8% NIIT tax now onto your 20% bracket, you're going to be tacking that on still to the 25% bracket. So in reality, it's 28.8% on your long-term capital gains. Okay. Another change that's happening is the QBI deduction or the 199A deduction. This is the pass-through business deduction. This one's, people have had a really hard time wrapping their head around it. I've had several posts on the blog about it. But the bottom line is as long as you're not in a specified service business, like medicine, 20% of your ordinary business income is a tax deduction right now. And so that is a huge tax deduction for a lot of business owners. The idea behind it was to equalize for S corporations, the lowered tax rates that C corporations were getting. That's why it was put in place, was to kind of make it a fair playing field. So you didn't have to change your business structure just based on tax law. So what are they doing? Well, they're not getting rid of it, but they're capping it. So if you're filing single, the biggest this deduction can get is $400,000. If you're married, it's $500,000. And so they're basically just decreasing it. They're talking about increasing the corporate tax rates too. So maybe they're still accomplishing the same thing where it's a level playing field between C Corps and S Corps. It's pretty much bad for any of us that have big 199A deductions. Another thing that's bad for S Corp owners is the NIIT tax change. Okay. The whole point of forming an S Corp is so you don't have to pay payroll taxes on the portion of your income that you call a distribution rather than salary. So if you're making $600,000, you might call $300,000 salary and $300,000 distribution. And you would save your Medicare tax on that distribution, 2.9%. You would also saved that Obamacare tax, 0.9%. So that was awesome, right? That's why you formed the S-Corp as a doctor, was to avoid paying those taxes. That might be $10,000 a year in taxes if you're calling $300,000 distribution instead of salary. Well, basically, they're just viewing that as a loophole that should be closed, and it's going to be gone. So even in whatever you call distribution, you're going to pay the same taxes on it as though it were salary. So there's really no point, if this goes through like this, to be in an S-Corp. And so that's a pretty significant change for a lot of white coat investors that have formed S-Corps for precisely that reason. Okay, here's another one that's going to affect a whole lot of people that make less than $400,000 or $450,000 a year. Under proposed changes, the Backdoor Roth IRA and the Mega Backdoor Roth IRA are gone after this year. If this bill passes in its current form, they're gone. Basically, you're not going to be allowed to do a Roth conversion of after-tax money in retirement accounts. You can't do it in your IRAs. You can't do it in your 401ks. So that basically means that step 2 of the Backdoor Roth IRA process is gone. And step 2 of the Mega Backdoor Roth IRA process is gone. This is your last year to do it. Obviously, if you want to make any of those conversions, might be a good idea to do that before the end of the year rather than waiting into 2022, because you're not even going to be able to do it for your 2021 contribution if you make it after the first of the year. It gets worse, though. You can't even do Roth conversions of pre-tax money starting in 2032. Okay, there's a big delay, another 10-year delay before you can do that. If you're a high earner, okay, so if your taxable income's $400,000 single, $450,000 married, you're not going to be able to do Roth conversions at all. That's basically going back to the way the law was before 2010. 2010, Congress changed that law, which enabled us to do backdoor Roth IRAs and other Roth conversions, and it's going back to the way it was before 2010. Okay, here's another one. There's a couple of new RMD rules. You remember the story of Peter Thiel? I think I'm pronouncing that right. But Peter Thiel's the guy who somehow managed to buy this startup company that did really, really well inside a Roth IRA. And so we ended up with this $20 million Roth IRA, right? And it made all this news, and it was in Forbes, and it was all over the place. And everyone was like, that's not fair. But anyway, this basically should be called the Peter Thiel rule in this tax bill. Basically, they don't want you to have big retirement accounts anymore. When I say big, they're talking about 10 million plus retirement accounts. Okay? So if you have more money than 10 million in there, and you have an income of more than 400,000 single, $450,000 married, you are going to have an RMD, even if you're not 72 yet. Even if you're 33, you're going to have an RMD, required minimum distribution. That is going to be 50% of the amount over 10 million. So if you got a $16 million IRA, you're going to have to take out $3 million. And the next year, you're going to have to take out, $1.5 plus million. And very rapidly, it's going to get very close to $10 million again. There's an additional rule for Roth accounts. If you have more than 20 million in retirement accounts, before you even apply the other required minimum distribution, you're going to have to take out the lesser of either everything that's Roth or everything over 20 million. So the RMD is 100% of everything over 20 million and 50% of everything over 10 million. So the good news, you're not going to have to pay the early withdrawal penalty, the 59.5 rule, that's not going to apply, but you're still going to have to take that money out. And so the bottom line for people who are able to get really, really large retirement accounts, you're not going to be able to do that anymore. Okay, another change that's going to affect fewer people is the idea of a defective grantor trust. That's basically going away. And people do that using irrevocable life insurance trusts as an estate planning tool. This law is basically making that so it's no longer a useful estate planning tool anymore. Maybe people buy fewer whole life insurance policies to put inside their irrevocable trust because of this. But it's, they're viewing that as a loophole that needs to be closed. Okay, here's another big thing, the estate tax. Right now, the estate tax exemption is basically $10 million per member of the couple, okay? So if you're married, it's $10 million for you, $10 million for your spouse, but that number was indexed to inflation, such that the total is now almost $12 million each, so $24 million in total. Now, that was scheduled to be halved in 2026. they're basically accelerating that. So it's going to be halved in 2022. So instead of having this estate tax exemption of $24 million for a married couple next year, you're going to have an estate tax exemption of $12 million. If you're single, it's only going to be $6 million. So the bottom line is a whole lot more people are going to need estate planning attorneys starting next year. Okay. Now that's just accelerating something that was going to happen in 4 years anyway. But it's definitely a change that's going to affect estate planning pretty significantly. Okay, here's another thing about estate planning. Family limited partnerships are becoming less useful. Now, the way people did this is they were able to pass assets on to their children at a discount. By putting it in the family limited partnership, the heirs weren't able to get it for a number of years, and that made it less valuable to them. And so it cost the estate less of the estate tax exemption to pass it to the kids via a family limited partnership. Basically, what they're saying now is those rules, those discounts only apply to real businesses, real family businesses. It doesn't apply to a bunch of, stocks and real estate or whatever, non-business assets you are trying to pass to your kids using that same method. So it's going to be a lot less useful for estate planning. The child tax credit is becoming more generous. Many doctors are still going to be phased out of this, but it could be as high as $3,600 per kid under 6 per year. So likely going to be more generous. The wash sale rules are going to change. Right now, there's actually what a lot of people consider a loophole, and that's why they're closing it. But wash sale rules don't count for cryptocurrency, commodities, foreign currencies, etc. It applies to stocks and mutual funds, right? You got to wait 30 days before you can buy that thing back. As the law is right now, you don't have to do that for Bitcoin. You can sell your Bitcoin, take the loss, buy Bitcoin back an hour later, and it's not a wash sale. So I expect that one is probably going to go through, given that the IRS looks at cryptocurrency now as a investment. They don't look at it as a currency. They look at it as investment. Okay, so what should you do about all this? Well, you ought to pay attention to it. You probably ought to write your congressperson. But for the most part, what can you do? Well, if you're planning on doing a backdoor Roth IRA for 2021, get it done before the end of the calendar year. If you're planning on doing a mega backdoor Roth IRA before 2021, get it done before the end of the calendar year. If you are planning on any other Roth conversions of after-tax money, do that before the end of the calendar year. If you want a defective grantor trust or an irrevocable life insurance trust, get it done before the end of the year. It sounds like any that are already established are going to be grandfathered in. Okay? Any non-business assets that you want to pass to your kids through your family limited partnership, get them in there before the end of the year. Don't bother tax gain harvesting, though. Get this, the long-term capital rate change is going to be retroactive to September 14th. So, just selling your stuff and buying it back to avoid paying 25%, so you can only pay 20% on it, that's not going to work. Too late for that already. And then, of course, remember, this is just a tax bill, and the final law is probably going to be significantly different. All right. Hope that's helpful as a review of what's going on in Congress. By the time you hear this, it'll have been another week from the time that I wrote it and or recorded this podcast. So something may have even changed in that time period. This is probably going to change pretty rapidly in the next few months. So keep an eye on it. Realize that something I said today may not be completely accurate by that time.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.